Morgan here, and this is Trading Forex. So in this analysis, I'm going to be telling us exactly how to enter a trade. I'm going to be teaching entries on these positions. I'm going to be teaching how I enter my position. So this breakdown is basically about entries, where you want to enter the market and where you want to exit the market. Using Nasdaq 100 as the study case, and I'm going to be using the 1 hour time frame for this analysis to keep it as simple as possible. So in terms of entries is one of the most important aspects of trading, because entries is going to determine how you can be able to profit from the position and how small you might be able to lose while you are in the position. So basically, if you enter a trade too late, then you're probably going to make less money and lose more money. But if you enter the trade at the correct time, then you're probably going to lose less money and make more money. So we are going to be looking at entries and seeing best way for us to maximize our potentials and take the best entries. So for this trade, right, you see that here, price is in an uptrend, right? And price being in an uptrend, that means that you want to be looking for buys and not sells, right? You want to be looking to buy the market because price is clearly taking out highs and respecting lows. So you want to be looking for buys and not sells, right? Let's use here for a case study. And the way I trade, my strategy is called ICC, which is indication, correction, and then continuation. And this is what I mean by indication, correction, and continuation. If this is a zone, let's say this is a zone, resistance zone, right? This is a zone, resistance zone, and its price comes here, rejects this zone, comes back here, rejects this zone, comes back here and rejects this zone, and then comes back here and rejects this zone again, and then finally price breaks this low, right? This is what I call indication. Price is indicating to you that, hey, above this area I can go this high. Now I don't trade this indication, and the reason why I don't trade the indication is because I do not know how high price can go. I don't know how high price might be able to go. Price might go this high, price might go this high, price might as well go this high. So I don't know how high price can go. So I want to be able to know how high price can go for me to know where I'll be targeting on my trade. So I don't trade my indications, I just let price run and show me how high it has the ability to go, right? So once price is able to make a clear indication and say, hey, above here I can go this high, then what I wait for is the correction, right? For price to correct itself and still respect these lows. So let's say price corrects itself here and then start to push back up. Now I know, okay, the indication that has happened because price has indicated to me, hey, above here I can go this high. So I have seen the indication, and now I have seen the correction from price correcting itself, because price always corrects itself. Down, I've seen the correction of price correcting itself. Now I want to get in on the continuation. That's why it's called ICC, indication, correction, and then continuation. So I want to get in on the continuation of price to keep pushing price above from here and to keep going higher. So I'll get in on the continuation. Once I see price above here during session, that's why I want to take the trade. I want to take the trade here and then target these highs, because price has been able to tell me that, hey, above here I can go this high and below here I can go as low as. So now that I've seen that price is above here, I am expecting price to get to these highs, right? So I'll be targeting these highs. So this is basically how I trade the market, and this is basically the strategy that I use to trade the market. That's why it's called ICC, indication, correction, and then continuation. Now I'm going to say that here. So in this case, this study, I took this trade on Nasdaq, and this was basically what I saw there. I saw this. This tells me that, hey, price was telling me, hey, above this high here I can go this high, right? Price told me, hey, above this high here I can go this high. right? Price was telling me, hey, above this high here, I can go this high. So this was the indication from price telling me, hey, above this high, I can go this high. This was the indication. So when price corrected itself, after correcting itself back above this area, I already knew that, okay, price can go this high, right? From here, as long as price is above this area, price can go this high. So I actually took two positions here, and this is how I took those two positions. I took my first position here, I put my stop loss below here, and then my TP was this level here, right? Which got hit perfectly. And then price tried to correct itself again, rejected these lows again, and it's back above this area. And I already know that, hey, price above this area can go this high. Price above this area can go this high. So I took my buys here again. I had my stop loss here for this one, and I was targeting these same highs again. So I basically made two profits, one trade on this position. Now I'm going to still tell us how we can be able to turn our day trades to swing trades. But for now, my focus is on entries. So you want to be able to identify the area where you think buyers are going to be in control of the market, and the area where you know sellers are going to be in control of the market. In this scenario, under this level, we know that sellers are in control of the market, and if you take buys under this level, then our chances of losing the trade is a lot more higher, because under these levels, sellers can be in control of the market. But then we know that above this level, that buyers are in control of the market, and as long as we are on the side of the people that are in control of the market, then we have the odds in our favor. So when you are entering a trade, you want to be able to identify the zone where buyers are in control and the zone where sellers are in control, and you want to be taking buys where buyers are in control, and you want to be taking sells where sellers are in control. So in this case scenario here, above here, buyers are in control of the market, and they can push price all the way here. So with volume in your favor and the buyers in your favor, all you have to wait for is session to come, because what you want to trade with the volume. So once you are in session, this is NAS 100, so it moves during New York session. So once you are in New York session and you see price above this zone, you know that, okay, price can go as high as this area, because we have volume in our favor, and then we also have the majority in our favor because buyers are in control of the market. So what I basically mean by all this is, I'm telling you guys that when you want to take a trade, you want to be able to identify where buyers are in control of the market, because that is what is going to decide on where you are looking to enter the trade. So once you are able to identify where buyers are in control of the market, then you are ready to take your trade. But if you can't identify where buyers are in control of the market, then you should wait until you are able to get a clear identification of where buyers are in control of the market. So like I said, name of the strategy is ICC, which is indication, correction, and continuation. So from now on, when you're taking a trade, wait for price to give you an indication of where you want to go. Wait for price to correct itself, because price always corrects itself, and then on the continuation back above where it came from, you want to be in the trade and take it to the continuation. Anyways, thanks guys, and good luck.